Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at the stock market, specifically what the Feds are doing. Looks like the Fed is the only buyer out there at the moment. So we're going to take a look at their balance sheet, what they're buying, and how they're buying. There's also some folks that are saying investing is dead. Just follow whatever the central banks are doing. So we'll kind of discuss what that means. All right, so the Fed might be the only buyer out there. And so banks are all agreeing that they've never seen a stock market so expensive. There's a chart from Credit Suisse that describes this whole thing as, quote, insanity, because it demonstrates that the U.S. careened into a depression with GDP crashing and the unemployment rate soaring. So this is showing that the S&P price to earnings multiple on the broader market had eclipsed the previous record of 19x during the market February all-time high. Now it's hit an all-new time high of 19.4x. So in other words, the market's never been more overvalued than it is right now. So according to JP Morgan last week, this graph is showing the beta of corporations moves in GDP is about 7x during the financial crisis. So as a result, according to the bank's chief economist, the current recession in which JP Morgan expects global GDP growth to collapse by the same 19.x% in Q2, which implies a huge plunge in corporate profits of 70% in the year 2020 second quarter. So meanwhile, with each day that's passing, you're seeing fundamentals disconnect and getting worse because the stock price is soaring, mostly the MOMO or momentum stocks with algos buying each other while humans are selling. You're seeing earning estimates crashing. Goldman Sachs is calculating in its latest bear case, the price to earnings multiples is now on a dot-com bubble-esque 24x. So that dot-com bubble is pretty serious. Pets.com is a perfect case study example of a company in 2000 trying to sell pet food that I think was $1 billion market cap and never sold a single thing. Revenues of zero because shipping dog food in 2000 was too expensive. And so we are now at that point where there's a lot of unicorns and a lot of zombies. So zombie unicorn, anybody? All right. So this graph is going to crash any bull expecting a V-shaped recovery. JP Morgan cautioned that the corporate profits won't recover their pre-pandemic baseline until 2023. Maybe. And so Citi is warning that equities are going to fall the same as earnings per share in a recession and reflecting a global market that's currently not reflecting expected declines of 50% in global earnings per share in 2020. JP Morgan is saying expect a 70% drop. So here's a little infographic about quantitative easing or the Fed's response of just printing money out. It's definitely unprecedented steps to try and stabilize the economy. Quantitative easing is essentially just the Fed's printing money. Although if you heard a little bit about Trump demanding that his name be put on the checks recently, rumor has it that the Fed is being overtaken by the Treasury Department, which would be historic. The Federal Reserve was established, I think, in 1917 and is a private company that charges taxpayers 6% to print money for us. So definitely isn't essential, doesn't it's not something that we want, and we are basically slaves to the Federal Reserve, all of them across the world that report to the Bank of International Settlements in Switzerland. So these are private banks. We don't want them, the Rothschilds, the Rockefellers, we don't want them in our money supply. One of them was quoted as saying, it doesn't matter who is in charge of the company as long as they're the ones that are creating the money supply. And that's the truth. So here you can see the total assets of the U.S. Federal Reserve. Normally, they do not go out and buy equities and assets normally. There is the plunge protection team since Reagan was president. That group was the working group, as it's technically called, was designed to try and help when the markets were dropping. So Black Friday, I think that was 1987, in order to help prop the markets up in times of stress, they were created. And so rumor has it that they're back there working to short precious metals and prop up the markets. And you can see that at 15 minutes before close every single day, there's a massive amount of buying. So that's the plunge protection team going to work, propping up the markets, been doing it for decades. So quantitative easing in January of 2009 started with just 2.3 trillion. And then 2010, another 2.9 trillion. Operation Twist came out after that in 2012. 4.5 trillion for quantitative easing 3, 3.7 trillion in 2017, followed by 6 trillion and counting for quantitative easing 4, with no end in sight. So looking at the Treasury Department's cash balances, they hit a record $899 billion. So starting on March 30th, the Treasury's cash balance was just 400 billion. So they unleashed a record amount of bill and cash management bill issuances. This chart shows that just in 9 trading days, the Fed sold a gross $1.2 trillion in bills, or just under 140 billion on average every single day. So the total supply may reach or exceed $1 trillion by the end of the month, an amount which will soon be rolled out over as the Treasury cash balances will soon tumble and won't be able to repay these maturities. So the federal deficit has just gone parabolic to almost $4 trillion. We've stated before, that's the velocity of money. So Obama had to spend twice as much as Bush, and Trump has to spend twice as much as Obama, and whoever comes after Trump is going to have to spend twice as much as him. So that's just kind of normal. Normal, I'm putting that in air quotes because fiat currency longer than 40 years is not normal. But here we are. So here's a graph for net Treasury issuances and quantitative easing purchases. Last week, Tuesday, Wednesday, Thursday, there was over $100 billion in new Treasuries each day. So if the Fed is monetizing all debt and helicopter money is coming, that means that we're going to see hyperinflation. That's the complete devaluation of the dollar. So you might be thinking housing prices are going up when in reality, it's the value of your dollar going down. So it's either a housing bubble or a devaluation of your dollar, or both. So we're just going to have to wait and see. But with helicopter money, that is the decline of any fiat currency, and we're almost there. So we can see here that the Treasury submitted to the Fed's repo ops is an increase in that usage. So within this week, we should see whether or not there's a liquidity crisis that's imminent. Real short, just the repo market is an interbank lending operation. So the banks can go out and lend to one another. But if the rates get too high, that's when the Feds jump in and offer some cash to keep those interest rates that could be as high as 10% per day on $1 billion. It's just crazy. So rather than that happening, the Treasury or the U.S. government comes in and offers an overnight lending operation, but it's been oversubscribed, meaning banks need a lot of capital overnight, and they're not paying it back at the end of the day. Like these are just recirculating. So as it comes due, they just kind of keep pushing that out and keep borrowing. So one of the world's largest asset managers said that they're just going to buy whatever the central banks are buying. One of the really old sayings is don't fight the Fed. What that means is that the Fed is willing to force a bull market with quantitative easing. It means don't fight them. And I made that mistake 10 years ago. Looking at fundamentals and technicals, I thought the housing market was going to collapse in 2011, and it should have. The only thing that propped that back up, if you look at it, was quantitative easing. So with trillions of dollars, you can't fight the Fed. Even the world's largest asset manager says they're just going to buy whatever the central banks is buying. Investing is dead. So what are the Feds doing? Well, central banks across the world are buying gold. There was a gold buying spree in February. The pace of gold purchases has slowed compared to last year's near record purchases. But that still amounts to 36 tons of gold added to their reserves in February alone, according to the latest data released by the World Gold Council. It was about 33% higher than January's total. So on the year, the central banks have bought 64.5 tons of gold. That was the second highest level of annual purchases for 50 years, just slightly below the 2008 net purchases of 656 tons relative to the 650 tons in 2019. So Turkey continued to be the biggest gold buyer. The Turks added another 24.8 tons in February. Russia further increased its stockpile. Russia's quest for gold has paid off in a big way. They've got very little debt. So Russia and China are accumulating gold. There's no doubt in my mind that they're going to have a gold-backed oil reserve as well as a gold-backed currency that they're going to share between Russia and China. And so It's my opinion that they both will drop U.S. Treasuries at the same time, and it'll be coordinated. And so this is something that the U.S. has done. You can look at several examples of economic hitman where the U.S. Back in the 80s purchased Russian assets, specifically oil assets, and then being a national commodity, they plunged the prices of those businesses that the U.S. owns. So George Herbert Walker Bush, with the help of Brady bonds, purchased a lot of assets, and like I said, they crashed those on purpose, and the ruble was screwed in the 80s. So that's the U.S. crashing the economy. They do that all over the world. Diaries of an Economic Hitman, great read if you haven't already. And so what happened is the ruble was worthless in Russia. I remember as a child wondering, like, why did these people have to go and with suitcases and wheelbarrows just to buy toilet paper? I didn't understand hyperinflation. I didn't understand a deterioration of their currency. And so that's what happens. But now they have no debt and a lot of gold, and they will drop the U.S. Treasuries at some point. They're going to do to us what we did to them. So fiat currency is dead, and the Chinese and Russians are going to make sure of that eventually. So Russians have been buying gold for the last several years in an effort to diverse away from the U.S. dollar. Russian gold reserves increased 273 tons in 2018, making the fourth consecutive year of 200-ton growth. Meanwhile, Russia sold off nearly all of its U.S. Treasury holdings, according to a Bank of America analyst. It fell from 46% to 22% in 2018 in terms of the U.S. Treasury holdings. Last month, the Central Bank of Russia announced it planned to suspend gold purchases for the time being. But the first week of April, Russian banks were already asking the central bank to restart its gold purchases. So only 5 countries have increased gold reserves by at least a ton, being Turkey, Russia, UAE, Kazakhstan, and Mongolia. And not surprisingly, the Bank of China did not report any gold purchases for the 5th straight months. It's not uncommon for China to go silent and then not suddenly announce or to announce it. Either way, a lot of people don't really believe in the numbers that China's reporting. I sure don't. I think it's a lot higher than what they're saying. There's a lot of analysts that believe China holds far more gold than it's officially revealed. So as Jim Rickards pointed out in 2015, many people speculate that China keeps several thousand tons of gold off the books. So if you haven't heard of Jim Rickards, he's an amazing, brilliant guy, probably the go-to person, in my opinion, for like political strategy. He's a gold expert as well, or I should say money expert. The difference between money and currency is that currency is an IOU for money. So dollars are currency, gold is money. So the recent market instability and uncertainty is going to be at the forefront of central bankers' mind, and that central banks are looking towards gold to balance some of that risk. Peter Schiff is a well-known gold bug anti-Fed. He said the days where the dollar is the reserve currency are numbered, and we're going to go back to basics. So central banks of the world are looking at gold again. That's according to Ron Paul, who made a similar point on the Liberty Report. So right as gold and silver demand nears its record highs, you have the U.S. Mint halting production as well as the Swiss Mint over virus fears. The timing of the decision to halt supply couldn't come at a worse time, with demand for both gold and silver coins soaring near record highs. Demand for physical gold is also soaring, so if you can find it, it's probably going to be incredibly expensive. Spot price versus physical is about 2 times the amount, so silver trading at $15 is going for $30. So according to Bloomberg, some of that production is being shifted to the Philadelphia facility with a temporary suspension of operations. It's going to continue to make American Eagle and American silver bullion coins. Sales for the Eagle coin was up 465% in April. So the timing is awful, but premiums are going to continue to soar. So if you don't have physical, you don't own gold. So the ETFs, as I mentioned, are 65 times oversubscribed. There's $600 trillion in derivatives. So just like gold, silver is also a hedge against inflation and uncertainty. So that's why recessions and extreme turmoil can lead to a massive spike in gold to silver ratio that we've seen. It hit 120. It's the highest ever recorded. So just prior to World War II, as Hitler launched an invasion of Poland, the ratio spiked to 98 to 1. In 91, during the first Gulf War, the ratio reached 100 to 1. And today we're back to that territory looking at 110 to 1. So as we mentioned, the Federal Reserve has already expanded its balance sheet to $6 trillion. That's 50% increase from last month, and they're just getting started. So whether it's the plunge protection team or just people shorting precious metals so that the central banks can hoard them for a cheaper price, either way, what we're seeing with the price of silver declining is leading to a record high gold to silver ratio. So as it stands to reason that if they keep printing money and the ratio eventually returns to its historical range, the price of silver could skyrocket. So looking at some leading economic indicators, we can see that the manufacturing index has crashed to the lowest ever. That means that new orders and shipments have declined at a record pace. You have delivery times lengthening. You can see that in Amazon Prime. Inventories are falling. Employment levels are insane, 22 million people last week. So looking ahead, some companies are anticipating a small improvement in business conditions over the next 6 months. So the index for future business conditions edged up 6 points. The index for future new orders and future shipments declined, but remained positive, suggesting that firms expect orders and shipments to be modestly higher in 6 months compared to recently. That's easy because recently we haven't had anything. So hopefully 6 months from now, we'll actually have something. And in addition, the capital expenditures and technology spending indexes both fell, a sign that firms plan to reduce both kinds of spending. Definitely seeing a huge decrease in spending on advertising right now. So you can see that year over year, headline and retail sales crashed 6.2%. It's the biggest drop since September of 2009. As you can see from this graph, the adjusted retail food and services total is the worst it's been since 2009. Hoarding did help the food and beverage and health stores with a significant rise in sales. That includes the grocery stores, health and personal care stores. So this was the biggest month-over-month surge in food and beverage store sales ever. But the scale of hoarding in food and beverage is offset by the utter devastation across so many other sectors. So while the market's crashing, you see the number of insiders buying the dip most on record, or actually almost the most on record, close to 1999 levels. So according to Smart Insider, it looks like the number of insiders in March from CEOs, CFOs, and board of directors, it hit $1.1 billion, the most since 2013. With plenty of corporate executives buying the dip. This includes purchases coming from at least 994 executives, an all-time high in the data running back to 1990. One of the most active buyers of stocks was the CEO of Wells Fargo. He bought $5 million of the bank stock last month. And so with all these executives and insiders buying the dip, you have just 5 stocks encompassing most of the market right now. So what we saw with the NASDAQ turning green for the year as Facebook, Amazon, Netflix, and Google's stocks hit an all-time high. Even as small caps were down 30% in 2020, you can see the ratio of tech-heavy NASDAQ to the small cap Russell, they hit a level not seen since the depths of the dot-com bubble. So this rally has bonds going up 109%, tech stocks 95%, small caps 27%, and global financials 22%. The S&P is now just a handful of these mega stocks because the chart shows that there's 5 stocks in the S&P now that account for 22% of the market cap, even higher than during the dot-com bubble. So as you can see from this graph, you have a more concentration from the 5 largest stocks than ever before, being Microsoft, Apple, Amazon, Alphabet, and Facebook. So insiders are buying. What is everybody else doing? What's a normal person doing? So Bank of America is showing that consumer spending has changed every day over the past month. So earlier, the Department of Commerce reported that March retail sales saw the biggest sequential drop on record and the biggest annual decline since the financial crisis. Spending with credit and debt increased 4% year over year. Consumer small businesses paying expenses and other payments slowed. And then the total payments in first quarter increased 9% with softening credit and debit card spending. So just like any recession, I would expect to see a rapid decline in new orders. You're going to start to see companies laying off people, having a lot of trouble repaying bank loans. a painful period when free market corrects the misallocation of resources and encouraging the government inflation. You're going to see consumers cutting back on spending so that they can buy and other things and save up. Businesses are going to lower prices to induce consumer spending. So the changes we're likely to see is going to be dependent on whether there's going to be inflation or deflation. That doesn't always mean that it's exclusive. You might see temporary deflation where prices decline in Bitcoin and gold, housing, followed by hyperinflation. So anything that's tangible is going to go up, and really that's just the deterioration of the dollar. So when the dollar collapses, tangible prices will skyrocket. So housing, art, gold, anything tangible that's a store of value will skyrocket because the dollar is deteriorating. So I don't know if we're going to have wheelbarrows and suitcases to buy toilet paper, but I do know that our time for the dollar as a world global currency is at its end. You can't just print trillions of dollars and keep that value remaining where it's at. So although it's the fastest horse in the glue factory, the cleanest dirty shirt, whatever analogy you want to use, its time is up. So plan wisely. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.